It's a broadcast.
Welcome, everyone. Just waiting a second for participants to join. I can see attendees coming in. That's great. Right. Great. Waiting a few more seconds for participants to join, and then we'll kick off. Great. Well, everyone is still joining. Well, welcome to this third of our webinar series for the Bank Governance Program. It's a pleasure to have everyone on this call and to have more participants joining as we go along. My name is Amir Amelzadeh. I'm one of the co-directors of the Bank Governance Program at the Saïd Business School, University of Oxford. And together with Karsten Alexander, who's also on this call, and Dr. Karsten Güttler, or our speaker today, who Karsten will introduce in a second, where we are very happy to have with us talking about a very important and very timely hot topic, I would say. So I'm expecting a lot of great discussion and insights. So this seminar today, as I said, about ESG and investments, or sustainable investing, as in a broader sense, and we will hear soon from Dr. Karsten Güttler. At the moment, I will hand over to the co-director, Karsten Alexander, to introduce our speaker.
Great. Thank you, Amir. And it's a pleasure to have the third seminar in our bank governance program. And at the outset, I'd like to also acknowledge the helpful support of the Research Network of Sustainable Finance here in Zurich and the Swiss Banking Association, through which we have been engaging with our discussions on developing seminars and webinars. And so we're very happy today that we have Dr. Karsten Güttler with us, who has extensive experience in the area of banking and asset management. And of course, when we talk about asset management, we sometimes think of BlackRock and the big investment management companies, but also we tend not to focus so much on what the big banks are doing. Big banks like UBS, Credit Suisse, Barclays, they have big asset management divisions. And so we're very happy that today we can have Karsten Güttler to speak with us. Karsten is Senior Investment Specialist within the UBS Asset Management Division. He is responsible for representing the sustainable investing capabilities of UBS to their institutional clients. Prior to joining UBS, Karsten worked in UBS's Wealth Management Division, and he was head of sustainable and impact investment and distribution. Before joining UBS, Karsten worked for Commerzbank in 2011. He also worked with Credit Suisse Private Banking in Zurich, and he worked with the Boston Consulting Group. So he's got a lot of experience with other banks and what they're doing in the area of investment strategy and sustainability. And he's currently the Senior Investment Specialist with UBS Asset Management. We're very pleased to have Karsten. He has a doctorate in entrepreneurship from Aachen University in Germany, and he also has a Master of Science in Financial Engineering and Marketing from the University of Bradford, and also a Master of Science from Leipzig Graduate School of Management. So he has immense background both educationally and in working with some of the leading international financial institutions in the area of asset management. So I'll turn it over to Dr. Güttler. Thank you.
Thank you very much for these kind words and introduction. Also, warm welcome from my side. And thank you for the opportunity to be speaking about a topic that is pretty dear to me, not only professionally, but also from the way I believe investments should play a role in society. So this is not only due to the fact that I have 3 kids who are pestering me pretty much from morning till evening that I do more in terms of societal returns. So we speak about that in a bit. So thank you again. And I would say, let me give you like a 15-minute introduction, how I see sustainability evolving, what are the drivers behind it, what are the most relevant influence factors to that, and then later on, I'm really looking forward to a fruitful and active Q&A. So I hope you can all see my presentation now. All right, so there are 2 parts to it that I want to show and discuss today. So the first one, I hope you can see it now. It says it's sharing. Okay, so theory and practice. These are the 2 main chapters of what we will discuss today around sustainable investments. So, and if we start with the theory. So what is sustainable investment in general, not only for UBS asset management? So at the end of the day, what sustainable investments is all about on a longer term view on return and risk. So we define the risk and the return component in a broader sense. And the objectives are improve risk-adjusted return in the long run. It actually have sort of a societal return, which is called the positive environmental or societal impact alongside the financial returns. So it's not a either or, it's an and. At the end of the day, it's also aligning values that you personally have, that investor has, with the assets. So this is, I would say, the heart of sustainable investments. If you would summarize that, it is performance plus. So you have pretty much the same risk-adjusted returns that you would expect from a conventional investment, but you will have a societal plus. And that's about it. And there are various ways of looking at it. You see here at the bottom, you analyze corporates for E, S, and G, which is often treated as a synonym for sustainability. And you do not only look at corporates, you also look at sovereigns, at governments, in order to evaluate what drives their sustainability return.
Karsten, sorry to interrupt. We still see your the front slide.
Okay.
It seems like the slides are not changing, I think.
Yeah.
Try it again.
For the viewers. Yeah.
We're currently just seeing the first slide of the PDF. You might need to share again.
Okay, try it again. So
here we go.
Yes.
Great.
All right. So that was pretty much the performance plus component. What are you considering when looking at sustainability? And the most important thing is long-term view. And this is, I would say, the key value add when it comes to assessing financial assets. So what is driving it? At first set, you see here the growth of sustainable investments over the past couple of years. And you see a CAGR of roughly 14% per annum. And this is quite interesting, as if you take other studies that look at the growth of financial assets, for instance, the Boston Consulting Group's one or PricewaterhouseCoopers Global Wealth Studies, you will find that conventional assets, they grow at a pace, at a rate of 6% per annum. And as I said, sustainable investment grow more than twice of that. And this is true for pretty much every region. You can see that here on the right-hand side. And I think the asset growth as such is right now predominantly driven by institutional investors. And what is driving the behavior of financial assets, or the allocation of financial assets of institutional investors? It's a lot driven by regulation. So what you see here on this page 5 is not necessarily stock markets. I would love to be that the stock market. It is actually the number of regulatory initiatives that deal somewhat with actual investments or disclosures in the context of ESG. You see, this is a fantastic chart, and it has impact, as you have seen in the previous slide. Just to mention a few of the global regulatory initiatives, a lot of that is about ESG. It's about sustainability, and in particular, it's about the environment. So the Paris Climate Accord has been, in the last couple of years, a major driver for regulatory initiatives across the board, including the US. And I think this has a broad influence on what institutional investors and also banks have to do. Keyword here, and IDD, the Insurance Distribution Directive, that will lead to institutional investors and banks and asset managers and also insurance companies asking their clients, do you really want to invest sustainably? And this is mandatory. So now we have seen what what policymakers want. Now the key question is, what do private investors want without being asked by regulators to act in a particular way? I have taken out here one part, actually that's the UK outlook of the UBS Investor Watch, where UBS is asking its private clients, what do you think about sustainable investments? Do you want to do it? And what you see here is the UK in particular is lagging behind. Only 1/5 of the investor base says, yes, I really want to invest and actually do it. I put my money where my mouth is. So more than 1% of sustainable investments dedicated to ESG investments. And other countries, as you see here, are farther ahead. And if you look at China, that's a particular interesting one. Now, what are the main reasons why these numbers are not even higher? Because if you usually ask somebody, do you behave or invest sustainably, or do you like sustainability? Then pretty much everybody will say yes, but seemingly not everyone puts the money where the mouth is. And one of the key drivers you see here on page 8 is that the terminology that's being used is pretty much confusing. You have a multitude of different terms that are sometimes used synonymously, sometimes not. Sometimes even different banks or asset managers use the same term in a completely different way. And that's why they say, if I don't understand what I do, then I rather do not invest. And that's the major difference between the institutional space, because there you have the regulator telling you what to do and what is right or wrong, but you as an individual with your own views, your own values, coming back to what I said in the beginning, aligning the values that you personally have with your investments, that is something much more dispersed and more difficult to actually implement compared to the institutional world. Now, there's a second question. What does sustainability mean? What is sustainable? I've just taken here one example of Tesla. Everybody knows Tesla. Everybody has an opinion about Tesla. And I've taken 2 different data providers that actually analyze Tesla. So on the left-hand side, you will find MSCI ESG research with their assessment. On the right-hand side, number 2 in the space, Sustainalytics. And they look at sustainability from various driver levels, but the conclusion is completely opposite. If you would believe what MSCI is saying, you would say it's a fantastic company. It's 7.1 on a scale from 0 to 10, with 10 being the best. And quite the opposite, when you look at Sustainalytics, they say, yeah, that's a challenge. And that is pretty much one thing that you need to consider as an individual. If nobody actually somewhat says, yes, this is sustainable and this is not, these are the standards we need to apply, then especially private investors say, then I shy away from it and I wait until there is a common sense established around it. Now, this was the theory, a lot of problems, it's growing, but what can we make out of that? So how can we synthesize all of these inputs into something that is actionable? Now we're coming to chapter 2, which is the practice, the implementation part. So first of all is transparency. I guess transparency is one of the most important things in sustainable investments or ESG, because you need to establish quite clearly what are you talking about. And what has been established over the time is a framework of 4+2 approaches, how you think about sustainability when it comes to investments. And these can obviously then later be combined, but what is the gist of it? First, the famous been around for the longest period of time. This is also quite natural for an individual investor because it tells you or lets you express what you dislike. And there are two ways of expressing dislike. One is based on a product. So I don't like alcohol, I don't like tobacco, and you see already the problem. Talk about ESG or tobacco not being good to a smoker. So probably you won't run into open doors. So product-based exclusions and norms-based. It's not about what you produce, but rather how you produce it. So if you just take, I would say, a water purification plant and it produces the most fantastic, completely energy neutral, cleansed water. But unfortunately, you employ children to actually reduce your operating cost. That would also not be considered as sustainable. So what is being produced and how are goods and services being produced? That's the exclusion. ESG integration is a risk view, and you see already in the mid, if you look at the market size, it's as big as the exclusionary dimension. This is kind of allocating a certain value at risk, a certain risk budget to ESG risk. So you kind of distribute your risk budget to not only financial risk, the traditional one, that where we all know how to analyze it and quantify it, but also give it a bit space in terms of ESG risk. And then you can think about one big ESG risk. So do I want to have one big company that is quite controversial, but I think the potential future reward may compensate for it or not, or I take little ones or take none. Now, and that's also the difference. Now we go into one of the strategies that you predominantly find in the private investor space, sustainability focus. This is about minimum standards. So you set out clearly what is a minimum standard, irrespective of whether not adhering to it might even reward you to a greater extent financially. But you say, this is what I like, this is where I invest, and there is the red line, I don't cross it. And impact investments goes even one step further because it just does not qualify a certain assets as sustainable or not, but it asks you to quantify the societal return. I.e., just take my water example. If you have 1 cubic meter clean water, it's great, it's sustainable. But having 1 cubic meter additional clean water in London, as opposed to in Goa in India, that makes a huge difference if you think in terms of death rates of children, diarrhea cases, or even sick days because of actually polluted water. So quantifying that means you need just not to know what products are out there, but also where they are being distributed. And then the stewardship, this is voting and engagement, this is supportive activities in order to make companies and government change over time. And it's ultimately also, you could kind of say, that is invest in positive change. So this is kind of parameters. If you look at the top 4 strategies and stewardship, voting engagement is an enabling factor. So what you see here, I just briefly touch upon it, page 12, you see sustainability focus on the right-hand side. This is really what typically private investors think about when they invest in a diversified portfolio from with a sustainability focus. So it means you have the exclusions, activity-based, you have norms-based exclusions, which is called single company exclusions. For instance, the UN Global Compact is important. You have ESG ratings that need to be better compared to a certain conventional reference point. On the other hand side, also a better CO2 profile, i.e., your companies in your portfolio need to emit less CO2 for what they produce. And last but not least, there need to be a clear active engagement, a stewardship component attached to it, so that there are certain societal outcomes that are promoted with the assets that you're managing. So how do you go about that from the infrastructure side? Obviously, you need to know what the sustainability profile of a certain asset is. And this is where research comes into play. So you can buy research. There are dedicated research companies like the ones we have seen, for instance, MSCI ESG Research or Sustainalytics. But this is usually just public data that is kind of being made easier accessible for an institutional investor. So you don't have to go through all the websites and all the sustainability reports and financial reports yourself. So you can just buy it. But by nature, this is always a bit backward looking. And that's why in proprietary research, every asset manager, every wealth manager does that. This is way less small amount of indicators that you're looking at, but they need to have a much higher predictive validity because you will be rewarded for future returns. And this is where these kind of internal assessments are geared toward. You're just one example for a fixed income research piece, and you benchmark it, you calibrate it, and ultimately predictive validity is here the key objective. And then aside from that, you monitor risk. We talked about ESG integration as a risk management tool. And what I've shown here is just an example of the in principle workings of our ESG risk dashboard. So we take a multitude of data in there, our own, as well as third-party data. There are different drivers, reputational risk drivers, governance, very important, absolute ESG risk. So there's a highly likelihood that, for instance, in the mining sector, something will go wrong sooner or later. These mishaps this sector is much more probable than, for instance, in the software sector. And this then sends out a risk signal, and depending on what strategy you are either allowed to take one or two of those high risk companies, or in terms of the sustainability focus, you must not. This is like a sustainability Lego. You have the tools, you have the data, but at the end of the day, what you want to build, this depends on your values and on your objectives. But having all these tools together, that is important, and that makes ultimately the difference. And last point that I want to make is, you've seen these ingredients, these Lego stones that you need to build something. And as I said in the beginning, transparency is key. And this is what we are doing now. Now you need to kind of synthesize everything back together and explain to investor what you have done. So what you cannot do is communicate the differences between the various data providers. So how do they assess a company? You need to decide for one. And then you need to communicate against that, irrespective of whether your strategy at an individual level is managed against a framework. But consistency in the way you're showcasing what you're doing, that is key, and this gives you the credibility, and that helps to overcome this obstacle that investors say, I don't invest because I don't understand in what I buy. So you see rating, ESG profile, you see carbon emissions, you see exclusionary norms-based as well as product-based, and you see even the SDGs in a combined way. And then you have, again, those 5 criteria. You promise something, you deliver against it, and you allow a third party to be the judge of whether you have done well what you promised or whether you made mistakes. And this gives the credibility that ultimately you need to have in order to be successful. So last word on performance, there's always been this discussion and debate about, is there a kind of a compromise that you have to make, like a trade-off between ESG profile and financial returns. So what I've done here is on this slide, and I hope you can numbers are rather small. This is a 1 year, 3 year, and 5 year return average of equity funds and bond funds across the whole Morningstar universe. That means all funds that are allowed for distribution to private investors in Europe are kind of categorized into equity US or bonds global USD or emerging markets hard currency. And then they are compared against the conventional counterparts in exactly the same segment. So gray is conventional fund, red is the ESG funds. And what you see 1 year, 3 year, 5 year, you do not necessarily need to fear that sustainable investments do underperform. It's on the contrary. But at the end of the day, and this is my closing remark before we go to the Q&A session, it's performance plus. You should expect the same risk-adjusted returns with the additional benefit, the plus being a societal impact, and that depends on how you build your sustainability Lego. With that, I hand back to our moderators for the Q&A session.
Great. Well, thank you, Karsten, very much indeed for a very insightful and thoughtful presentation discussing the theory and practice of sustainable investment. We've got some questions that are coming in, but I thought I might just ask one to kick off the discussion. It has to do, you mentioned in one of the earlier slides that regulation seems to be one of the primary drivers in the development of sustainable investment practices. And we see a lot of regulatory initiatives all over the world. China tends to be doing a lot more than, say, the US, for example. But nevertheless, regulation is very important. Do you feel that there is any benefit to having a more harmonized international regulatory approach to sustainable investment? We see now that many national authorities like the US, China, UK, Switzerland have varied approaches. Do you think that regulation could play a more useful role if it were more linked up or possibly more harmonized?
Yeah, there are two hearts here beating now in my chest. So when it comes to, if the primary objective was to channel and allocate as fast as possible, as many assets as possible to a common goal, for instance, let's take climate change, or let's talk about net zero by 2050. Then yes, this alignment would help a lot. However, when it comes, there's now the second part to it, when every investor does pretty much exactly the same, so you're hunting assets that are at some point in time rather scarce, then you will have a high probability that you have misallocations of assets. So you will have assets prices that have nothing to do with reality. They will just be inflated because every investor is hunting exactly the same assets. And that is a challenge. So in a nutshell, I like diversification. I've done investments all my life, and there is one truth, is the only little inch against defaulting or underperforming when it comes to your investment returns is diversify. You need to diversify. And that's why I'm not too keen on having the Bible of sustainability, right? So whatever you said, okay, this is exactly how we define it, this is exactly how we measure it, just to avoid these misallocation effects. So I rather have 3 or 4 more years where people say, maybe I still don't know yet, I need to find my way, or maybe even use the asset managers, the wealth managers, in order to give feedback what they think, because they all have different perspectives. Then if every sector does it in an aligned way, but slightly different, then the danger of kind of these unwanted side effects is probably a bit more mitigated. And I think this is 2 or 3 years of more confusion well invested.
Okay. Thank you.
Yes and no.
I think we have a question or coming in, or Amir, would you like to ask a question?
Yeah, we have a question. We'll get to that in a second. Please keep them coming. Let me get also one question in before we get to the audience, and in particular because you mentioned it right at the beginning, Karsten, that there's still some skepticism. So you mentioned it doesn't seem to look like private investors are putting their money where their mouth is. So this disconnect between institutional investors and institutional products and private investment. So then the question I have is then, so where does the skepticism then come from? Because as you also said, your children are pushing you to do something for a society and in the environment. So it seems like the newer generations are pushing the older generations to shift wealth also into these sustainable products. So is it that we're still skeptical about the returns? Is it the confusion that is making us skeptical, or is it the skepticism around the actual impact that we are having with these?
Yes, there are two things I believe that are little obstacles on our journey to more assets on the private investor side, invested sustainably. One is being this confusion, this terminology topic, and that is exacerbated or made even worse because the majority of advisors, they are not yet so comfortable in advising their clients around sustainability because they're facing exactly the same challenge. They need to somewhat side with a view on ESG, on sustainability, be it on the data side, be it on the norms side. I mean, I said, if you want to say, I built a sustainability focused multi-asset portfolio, which is usually the case when it comes to advisory. And you need to think about, do I commit myself to avoiding alcohol, tobacco, or even nuclear? So these are things where there's no standard. I mean, if you ask a Frenchman about the sustainability profile of nuclear energy, you will get a complete different answer than you would ask a German or an Austrian investor or a Swiss investor. And that's why they don't like to go out and say, okay, this is my view, my dear client, you should invest exactly like this. And it's less concerns about returns because everybody has understood by now that it's probably not the worst idea to invest sustainably, but talking about it, advising about it, framing what sustainability means in terms of a portfolio context, that is the key challenge. So I don't think that the individual investor is the bottleneck. I strongly believe that the client advisors are the bottleneck in not daring to advise their clients right now. But this is diminishing over time. It takes a lot of efforts and trainings, and UBS is in the same situation. We need to train. Only then will you also see a pickup in the private investor space. Once a private investor has done it, they see the performance, they see what's happening. And then actually you see the assets flow in. And the second part is also a very valid point. What is the actual impact? So we're talking this impact bucket that you were mentioning. So quantifying societal return of your investments. And this is a bit of a challenge because it's expensive. It's not mission impossible. It's actually very mission possible, but it's super expensive. And if you, I would say, offload and allocate cost for impact measurement to a certain investment strategy, then it will underperform. So either you shy away from measuring it, and that's right now still the situation for the majority of asset managers. You simply don't do it. You treat impact investments like an R&D department, even like a philanthropic investment. So you just focus on those investors that say, I want to advance even academia in terms of how to measure societal impact. And then I intentionally take into account that it might reduce my risk-adjusted returns because of the additional cost incurred. But this is not the case for the majority of investors. So this is now then the second part. So impact investments, client want to know about it, but they usually don't want to pay the bill.
Thank you. Yeah. So let's move on to the questions from the audience. There's a few coming in. So there's one question on that asks, how useful is an ESG consensus score? Wouldn't it nullify the usefulness of contrarian ESG view, which may very well be an early warning of a particular company? So essentially, I'm assuming it relates to your comment on if everyone is running, investing in the same companies, so everyone's looking at the same ESG scores, are we not just creating essentially another problem?
Yes, exactly. Yeah, I fully agree. I mean, this is exactly my point, why I was saying I'm not the biggest fan of having one institution saying this is right or wrong in terms of sustainability. I like these differences. I like diversification of views. And when it comes to the risk dashboard, one could also treat it in the following way and look at it in the following way. So if you have different drivers behind a certain ESG rating or ESG score outcome, so it can be an absolute rating, it can be a relative approach, the materiality metrics, so how important E, S, and G dimensions are relatively seen in each sector to assess a certain company. They are different. Then if you take that into account and combine it, and I would say 3 out of 4 input factors based on complete different views on what sustainability is and whether a company or an asset is sustainable or not, and everything says it's a bad company, then it's very likely a bad company. But if, like in the case of Tesla, if it's one says is great, one says is bad, you need to ultimately figure out what makes most sense. And there comes into play your own proprietary research, where you say, I do not just want to look at what the company is doing now, but I'm here to change in the future, because the capital markets do not reward you for what has already been implemented. What's the status quo? They reward you for what is being done in the future. And if your own valuation says, okay, it sides with Tesla, let's say MSCI, so maybe that has a more predictive validity. I'm not saying here that is the case, but I'm just saying assuming it. So then you make your investment decision accordingly and follow the route of invest in positive change, and will be hopefully rewarded at a later time for that. So diversification is key, and asset inflation will be the result if you would follow like sheep just one indication how things should play out.
Karsten, I thought I might ask a question having to do with the role of the investor. You had mentioned earlier in the practice of investing, and you had divided it into exclusion, integration, focus, and impact. And it reminds me a bit of the corporate governance debate between exit and voice. You know, what is more effective in improving governance? And do you have any thoughts on that? I mean, do you think the investor, for example, might be more beneficial by being more proactive, or should they just simply have a more exclusionary strategy of relying more on exit?
Yeah, well, this running for the doors approach, I've never been a big fan of it. I understand the logic behind it because it solves my problem right now, but it solves it in a way that you just say, okay, I close my eyes, I don't see it, and just because I don't see it, it's gone. That is not necessarily an approach I do pretty much buy into. So being a responsible investor means pain. It's not so easy to get rid of any challenge just by closing your eyes or hitting the red button on your trading terminal. So it's a painful process in order, if you really want to change something. But if you would run through the doors all the time, what would be the implication? Every company would at the end of the day know that those investors that remain, they don't care about any problematic way of doing my business. So why would I change? But it's definitely, I know that from the engagement programs that we have with companies, it's a painful process for both parties, right? Because at the end of the day, it's like giving homework, right? And nobody likes homework. That's just what it is. But at the end of the day, if you look back also on our personal CVs, without homework, we would probably not be able to attend university to move on. And that's why it's so important, although it's not necessarily all the time big fun. And engagement, there is also something what you can do is you can measure whether successful engagement, and I clearly admit not every engagement is successful, right? But successful engagements tend to lead to outperformance. I give you one example because I can talk about it, it's public. If you just for the sake of curiosity look at Royal Dutch Shell, I mean, we're talking in context of climate. And definitely it's not a green company, right? So nobody would dare to claim that. However, there is an initiative, a combined shareholder action initiative called Climate Action 100, and they engaged Shell. And end of 2018, I think it was the 8th of December 2018, Shell published that they really want to go net zero going forward. And they want to reduce their footprint, and they actually linked the compensation of the board against that. And if you just look 2019 and 2020, what happened, how they adapted their business model, it's slightly a different company now than it used to be at the end of 2018. So change happens, and also societal returns will happen. Now, question is, did the investors also gain something out of it? Because at the end of the day, investors are not charitable or charities, right? And now, what is the alternative that you can do as an investor? What options do you have? So Shell is one. You believe in the change story, you invest. Option two is you say, I have no opinion whatsoever, and that's not so uncommon, believe me. You buy the oil and gas sector. For instance, the MSCI World Oil and Gas. Third one is you say, I do nothing, I buy cash. Probably these days not so a great idea anymore, given the negative interest rate environment. And the third one is you go contrary and say, that's all crap. I don't believe in that. I buy Exxon. Yeah. So, and if you just look at the performance outcome after announcement of these engagement programs, and obviously not everything can be attributed to the engagement program, but you will see that Royal Dutch Shell outperformed the oil and gas market. It definitely outperformed the central bank deposit rate. It outperformed Exxon, so it was a good investment. And again, not every investment in this case will turn out that positively, but invest in positive change, that is something that usually works in quite a significant number of cases. And again, the capital markets, they reward you for future action, not for the status quo. And that's why being proactive is much better than running out of the doors.
Thank you.
Very interesting. No, I can just confirm what you just said, Karsten, for this one case on academic evidence that essentially shows the same thing for a large sample of engagements on ENS issues. And a colleague of mine here at Said is looking at shareholder resolutions for ENS issues and finds exactly the same as you say. So even they have a very low threshold of going through, but there's positive change that comes out of this, also returns for investors. So can only confirm this. A question from Araceli Gutierrez is quite interesting. A question about if companies must include supply chain in their ESG reports and if investors ask for this. So in a sense, if we think about recent things that happened, for example, in a particular fashion retailer in the UK and problems in the supply chain, should companies be responsible for their supply chains? And do you see, are you interested in, are you looking at this as well as an investor?
That's a very interesting topic, because this is also something that that affects investors to a great extent. I mean, reputational risk is also sort of a component of the valuation and of the risk assessment that should not be neglected at all. And if usually something goes wrong, it tends to be in the supply chain down the road, because these are usually emerging market suppliers, less transparency, control is at best below average, if at all. And it poses a significant risk to companies, right? Is it directly affecting valuations? And if I look at what I've done on analytics in the past, I would say no, it's not that close right now to valuation, but it will change. And a wise investor is always prepared, because right now, even if you would say it would become relevant, you would still not have enough data. So trying to collect data early on to be prepared once a certain additional driver becomes relevant is probably a good idea. So to answer your question, should a responsible investor take into account what happens in the supply chain, even N-2, not just the direct suppliers? Yes, they should. Is it from an investor's perspective right now the most relevant topic? No. Will it remain as it is? Probably not. I mean, you just need to consider one simple fact of life. So what is sustainable is ultimately the core driver for your license to operate. And your license to operate is not just about valuations, it's also about what does that mean? And you need to put it into the context of time. If you would look at what happened right now in context of climate, 15 years ago, nobody would have ever gone out on the streets and actually protest against global warming. But it is now a case. So environmental topics affect valuations now. 10 years, 15 years ago, probably not that much. Supply chain, I would say, is the next step that will come after that, probably not in the next 2 to 3 years. But you see already, for instance, in Switzerland in December, there's an initiative where the populace is being asked to vote on whether companies should take responsibility for what happens in the supply chain. And this is just the first step into that direction. But again, prepare now, collect the data as soon as possible, not necessarily use it already for valuation, but be prepared is the best thing you can do. And supply chain topics should be also, and they are already also a component in the engagement discussions we have with a couple of companies, but obviously that's then not public.
Karsten, I'd like to ask you, you had mentioned earlier the how UBS, for example, collects data on sustainable practices. And of course, the definition of sustainability is very broad, but the bank itself, the asset management division, seems to be doing a lot of work in investing in information about sustainable sectors of the economy. But also, of course, it relies on third-party sources for information on sustainability, like sustainable rating agencies. And,
Yep.
and I was wondering what you felt, what type of balance should an institution like UBS strike between the internal data you get and then also reliance on third-party sources of data regarding sustainable factors?
Mm-hmm. Yeah, well, it's a very important question, because whatever you do, ultimately, even data is an investment. And what happens more and more is that you could consider sustainable investments or ESG investing as a big data game. So at the end of the day, it's all about predicting future outcomes and selecting additional drivers to it. Now, how relevant becomes buying external data versus doing your internal research? I mean, at the end of the day, data is a tool, and you need to apply it in the right context. So, for instance, if you would look into equities, then probably upside potential for the future, so alpha potential that you can unlock using proprietary research is theoretically higher. However, the transparency levels in developed markets is rather high. Whether it's worthwhile putting an additional analyst resource on developed markets equities, that's to be seen, right? We know that active managers in developed markets do not necessarily tend to outperform passively managed strategies. And that's because the data quality is high. Same topic, equities emerging market might be different, right? So you look at the index performance, if you compare passive indices, ESG indices in emerging markets with the conventional one, you don't see the same picture that you would see in the developed market. So putting analyst resources there to unlock alpha, that is clearly something that makes sense more in the emerging markets than in developed markets. Fixed income, where you have also non-listed issuers, it makes even more sense to put additional proprietary research behind it. So it's the use case, the strategy determines your investments. But since the majority of assets right now, also given the interest rates, the focus is predominantly on the equity side, the data game and combining data and trying to unlock additional sources for alpha is out there. So there's no surprise that the majority of larger asset managers and asset owners will have one, I would say, home-based data provider that they consider their primary data provider. But nevertheless, they will not rely just on that. They will kind of complement that with other data providers, be it for calibration reasons or to figure out or get more ammunition to distill additional insights out of that cannot be captured by each individual external data provider itself. So means to ends, that's data. But more data is required. And I guess if you just look also at listed prices of equity prices of ESG data providers and just compare that to the broad market, you know where the game is going.
Right.
May I just follow up on this? I think in what you just said, there was something interesting with the distinction of developed versus emerging markets. So would I then be correct as an investor to expect a sustainable investment strategy or an ESG integration to deliver more positive returns or higher alpha in emerging markets than it would in developed markets? So would that strategy, is sustainable investing essentially better in developed markets just because the information is, there's less information and we're getting more information on companies?
In absolute terms, whether developed markets are performing better than the emerging markets or vice versa, that has nothing to do with ESG. That's just the fundamental business model of the region. But within each sector, proprietary data versus publicly released data, that makes a difference. So I would phrase it differently, saying I would not necessarily expect an additional analyst doing some research in developed markets to provide the same amount of alpha compared to the same resource actually put into work analyzing emerging market equities or fixed income issuers, right? So that would be my answer. But equity versus fixed income, that has nothing to do with sustainability. That is just, I would say, capital markets driven by macro topics. And they are not being changed by ESG as such.
Karsten, I couldn't help but look at some of the countries on the chart regarding the performance of funds. And what it does show is that funds, equity funds and bond funds that do have a focus, sustainable funds, tend to, on average, perform better and to lose less than conventional funds. Do you think, why do you think that's the case? I mean, so consistently across the board. Is it the way that we define sustainability that really influences that figure more? Or is there a real value, do you think, for the investor in seeking out more sustainable investments?
Well, I would say in general, sustainable investments should not necessarily create alpha. Especially not in developed markets, because the majority of information is incorporated. If everybody does proper analysis work and assesses the assets properly, you should not be able to do so. So why you see that? So this is now a bit of guesswork, so I cannot prove it. But one suspicion I do have is you have sort of a transition alpha. And one of these reasons is that right now, a lot of institutional investors, as we have seen in the regulation, as part of the discussion around regulation, and let's not fool ourselves, right? Institutional investors control over 80% of global assets, so they are the driving force of where assets are going. It's not the individual investor that does that. So they have now the clear objective to become green, or at least E and S, environmental and socially conscious, and consider more ESG. So that means they need to sell certain assets that are less compliant to this new philosophy, new standards, and buy more of those assets that do. And this is exactly what you see here. I think you see kind of a transition, or the implications of a transition from a less sustainable world to a more sustainable world, and I expect these outperformance to reduce over time. That's one. That would be the philosophical answer to it. Now, if you look at pure quantitative indications of that, what does ESG mean? So what does ESG correlate with when you talk simple factor investments? And you see a rather high correlation to quality, to growth. And over the last 10 years, the good old discussion, value versus growth, was clearly won by the growth factor. So since sustainable investments have a much higher exposure to growth and quality than these grayish conventional funds here that have a bigger exposure to value, you could also argue this is because the growth factor in particular outperformed the value factor significantly over the past decade. I'm in discussion with our portfolio managers and also third-party portfolio managers. They all keep telling me, yeah, but the value for decades has been the driver. And next year everything is different. So value will come back. And I always keep saying, yes, maybe, I cannot predict the future, but I'm a strong believer in the allocation implication of regulation. And as long as the transition from the old world to our new regulatory world is not concluded, as long as even more regulation is hitting the road, I really have a hard time to believe that value is getting back in I would say, a substantial and prolonged way. So it will at some point in time, for sure, but probably later than we all might expect.
And I can't help but to add that the UK fund managers in equity funds do particularly bad, don't they? Why is that the case?
Well, I would not say that these are the UK managers. This is just funds dealing with UK equity. And I guess if you look at particular the last 3 years, I guess you need to look to Downing Street and write your thank you letters there.
Thank you.
Thank you, Karsten. I'm conscious of time. Maybe I'll give you the last word if you want to say maybe what investors, the last piece of advice for investors that want to invest sustainably. What's the way to go? What does the future look like?
Oh, that is the good old question. Well, predicting the future is difficult. And I think as an investor, you need to make conscious decision what you want to achieve, what are your objectives. And in discussions, should I invest sustainably? Should I stick to what I have until somebody tells me what sustainability ultimately means? So we have this looked for unified definition of sustainability. As I look, forget it, it's not going to happen, right? You need to implement your conviction. And what you should do is you should quantify the implications of what you are doing to the letter. You should not follow any pursuit and say, just because I see Greta Thunberg every morning demonstrating in front of my office, I should now be a climate investor. If you want to do that, you need to always explain why. What do you expect out of it? What is the main reason why you're doing it? And that's why I am allocating my funds over there. We have so many data already that can pretty much implement everything. But coming back to my little thought picture about ESG Lego, the building plan, what you ultimately want to build, that is your job as an investor. Then I have Lego stones, they need to fit. I cannot combine Duplo with Lego, although I learned from my kids it's possible. However, ultimately, you should stick in one set of criteria that you're considering. You should take as much data as possible in order to make a conscious decision how to implement. And ultimately, sustainable investment is not so complicated. You have an asset allocation, and the risk-adjusted return or the capital market assumptions behind it are no different, right, compared to traditional investments. So you have your allocation problem in the same form and shape than you had it before. What changes is the selection and the filter criteria. How do I select assets to populate my strategic asset allocation or my tactical asset allocation? That is where ESG comes into play, and this is driven by your conviction, by your thoughts. And I always will tell them, look, even greed, although you would not necessarily communicate like that, being greedy is a legitimate objective, right? Because you can optimize short-term trends and actually capitalize on this transition alpha if you want to. And also a little fun fact as a sideline, if you look at corporate disclosures, we talked about this supply chain topic. You can also say there's a UN Global Compact, the norms-based exclusions. And if you just look at the alpha potential of, for instance, excluding, although I said I'm not a big fan of exclusions, excluding companies that fail certain norms. Look at the GPFG, the Norwegian State Pension Fund. They disclose the attribution of negative exclusions, and it generates alpha, right? And then if you would advise a client and say, look, just focus on, for the sake of simplicity, on negative exclusions, and then you look how they communicate what they did, there's a complete different narrative behind it from where we started off, which was maximize alpha, be greedy. And this is what you need to consider. How do I communicate? What do I have to communicate? What are my objectives? And the rest is pure mechanics. So don't shy away from doing it. And don't wait for somebody to tell you what is sustainability. You will never get that answer. At least not in my remaining lifetime, I probably fear. Just do it.
I hope the call to action is heard, and
Yes.
many will implement their own strategies and communicate them accordingly, as you say. So, Karsten, thank you very much for these insightful comments and insightful presentation, and for standing in for all the questions, some tough ones. So thank you very much. This is a very interesting topic, obviously very timely. And hopefully we'll see more action in this, moving in this direction, and more funds invested in more sustainably for all our future. So thanks everyone for tuning in. Thank you for your questions, and we will continue with other webinars in the future. Stay tuned. Thank you very much again, Karsten, for joining us.
Great.
Thank you for having me. Have a good afternoon. Bye-bye.
Great. Thank you. Bye-bye.
Thank you. Bye-bye.